Hey, good afternoon. This is Bob from Trade Genius. It's the 14th of December, and talking to you from sunny Southern California, at least for today. A couple more days, we're going to have some nice rain here, and looking forward to pretty much the end of this drought for California. Rain from San Diego all the way up to Redding. North are full. The middle, they're getting full. And down here, we're going to get some nice soaking rain. So looking forward to take that worry off the list. And what I want to talk about is the post-Fed analysis that's going on right now. And the stock market didn't like the Fed news and the fact that they're claiming that they're going to do 3 rate increases next year. And the reason they gave for increasing the amount of rates raises they're going to do is that it was Trump. You know, his fiscal policies are going to be disastrous. They're not going to add to productivity of the country, and they're going to cause unwarranted inflation, and they have to be now vigilant, which is really ironic. So for 8 years, the Fed decided they weren't going to be vigilant to allow fellow socialists to do whatever fellow socialists do, which is basically spend us into oblivion. And for the last year, the Fed has been telling the world that it's time for governments to step up fiscal action so they can back away from monetary action. And that because they're setting the stage and the narrative for Hillary to continue on with this spending, which they were going to back. Hillary, and it's not a globalist, and it's not a friend of the Fed. They've now all of a sudden have found a backbone, and they're going to raise rates, and they're going to essentially kill the economy. And we had this before, and the last time the Fed raised rates and they announced that they're going to do 4 increases, is that price of oil was cut in half. You know, obviously they slammed gold. The economy rolled over, and the stock market went down 18%, and they had to panic and push out the rate increases. Now this time, this is the second increase. The economy is becoming fragile again. We just had announcements today that industrial production and retail sales have fallen, and we had actually month-over-month falling of restaurant sales. So we're going into recession, and they're raising rates into a recession, all to spite of somebody that's not in the in the clan, if you will. And this is really going to be dangerous. And you know, Trump's policies, though, you know, it's also going to be dangerous too. So I'm not just putting this necessarily at his feet. I mean, at the Fed's feet, is that the economy worldwide has been kind of collapsing away from globalism. A convenient excuse to basically blame Trump, and so it's going to be a big issue. You know, what happened here with the yen, and they used the yen to do this, is that the yen has been devalued 16% against the dollar. The yuan, which is the currency for China, is down 5%. I think the euro is down 3 and 4% against us. These are the biggest currencies in the world. That made every one of our multinational companies relatively uncompetitive, and that's not baked into the earnings reports for January. So watch out for that. The other thing, last time the yen got devalued like this, it collapsed the commodity markets. We've already seen it do for gold. Today, oil rolled over really hard. We knew the whole OPEC thing was a hoax. Stay away because they're pushing so much money into the oil markets that they're crushing every short. But you know, we're down to $50 again for oil, and oil. And I said this before, oil is going to go back into 30s. I've been saying it all year, and they were telling you it's for the trade. Well, we're going to be in the mid 40s here in the next week or two for sure. Getting all the snow around the world, people don't drive as much, and they're overproducing oil, and they just gave the American shale producers carte blanche to produce as much oil as possible because they locked in their price for the next 6 to 9 months. So the good news for us is that's going to go down. The bad news is they raised interest rates on everybody, so everybody that owes money is basically now going to hand it over to the banks. And the reason the Fed definitely raised rates is for the banks. You know, they with the reserve they get, they don't have to lend the money out. Ride with the Federal Reserve, and this quarter point bump, if they don't raise their margin costs to the banks, they get to pocket that. And you're talking $4 trillion worth of that they're earning interest on. So we no longer really have banks. We have these money making machines that get free money from the Fed. So you know, that comes out of our government directly to the banks. And now you layer on top of it all the increases of the rates, and it's going to kill the corporations that are borrowing interest rates to basically buy back their stock. They can't do that anymore. So we have a confluence here of some really big problems coming. So, you know, the banks hold, you know, the oil markets loans. Well, that's going to be in jeopardy if oil keeps falling. You know, consumers are already at the wall, and so you're going to see bankruptcies increase there. You know, and you're going to see losing their foreign markets. So it's going to be a recipe for disaster. You know, short term, you know, we're probably going to wiggle to the end of the year, and going into January, I think people just are going to bail out for a pretty hard sell-off. So if you haven't got out and you rode this thing to the top, you know, hey, congratulations, ring the bell, go to cash, sit for another 3 or 4 months and kind of play things out a little bit. I think you're going to be able to buy the stock market a lot cheaper. Anyways, Bob from Trade Genius, I'll catch you later, and have a great night, and I'll see you guys in the markets. Bye-bye.